as you've probably seen on the news, both have been increasing over the last year, and that's predominantly because of inflation, which is kind of the general rise in prices. And you can see I've just shared here both articles, so both are sort of increasing to sort of high numbers, and we can see what they were over a period of time. So what we see here is taking a chart for a longer period of time, 2004 all the way to 2022, and we can start to see where interest rates have started to go. It's starting to creep up to the last year. When you look at the Fed's fund rate, which is the one interest rate in the US, to close to just above 2.25%, and it's looking to creep up to 3%. So that's going to have major implications for you in your portfolio and in individuals generally. We'll go through that a bit more, but the Fed's fund rate, what it is in essence, is the rate at which banks can borrow from the Federal Reserve or borrow with each other overnight, and then that has repercussions for other borrowing rates, as I'll discuss a bit further on. And the Bank of England rate is the rate that you have in the United Kingdom, which the Bank of England, which is the central bank, raises, and you can see here in the chart, it's gone up as well, quite dramatically over the, and that, you know, it's been very, very low for a very, very, very long period of time. And suddenly within the last year, it's just spiked up. And the reason, once again, is they're trying to curtail inflation. And inflation, for those that know, is a killer for anyone's portfolio, because it basically means a pound or a dollar is worth more today than it is tomorrow. I mean, that's always been the case with inflation, but if inflation is rising quite highly, it means that the cost of everything's going up, but the real value of things are going down. So the purchasing power is going down. And the reason for inflation going up, as you've seen, is various cost inflation, cost of inputs, cost of also the cost of inputs is one thing, but also the cost of COVID pandemic. What is the impact of that? The impact of it means, again, like I've explained, borrowing more. So in a low interest rate environment where we were for such a long period of time, what this graph is showing since 2014 is that, let's say for businesses, you know, they were borrowing in total in the US $10 trillion, and that's increased massively all the way into 2022 to being double that. So because debt was so cheap for so long, borrowing was so easy to do, and people would just borrow because the cost of borrowing, either the interest rates that they have to pay back on a monthly or 6 monthly basis, was a lot lower. Now, what does that mean in terms of sort of cost for borrowing for companies? Well, this graph, what it shows is it's called the US high yield index option adjusted spread, and what that is representing really is it's the spread. It's not the entire interest rate, it's the credit risk above the existing interest rates. So interest rates are rising, so naturally high yield, which is basically bonds or sort of instruments in the bond market, which are basically debt markets that have a very low credit rating, so below BBB minus, so BB and below, so they have higher risk of defaulting, meaning these companies have more risk of paying back their debt. You've suddenly seen a spike in the last year of the willingness of people to lend to them, so they are requiring a high interest rate because of the risk. Obviously, interest rates rising, and meaning that people feel that suddenly climate's changed and there's more prone to recession, which we'll look at, and we'll talk about a bit later. But what does that mean for you, the individual? Well, naturally, if interest rates rise, it means your mortgages and everyone's mortgages, where most people have mortgages, the mortgage rates will rise, and means the cost of borrowing is rising for them. So most people have fixed rate or floating rate mortgages. They'll be fixed for a certain amount of time and then standard variable rate. And it means that suddenly those get really much more expensive. And that's the thing that you have to worry about, is the cost of borrowing suddenly going up for individuals. That means they have less spending power. What does less spending power mean? Well, it can lead to a recession. And this is what we're talking about here. So a recession is really what we define as 2 negative periods of GDP. And GDP, or gross domestic product, is, I'll explain in a minute the formula, but it means in essence that things are contracting. So GDP is contracting, maybe it's high employment, high consumer spending. But what GDP is in its essence is this formula. It's consumption plus income plus government expenditure, exports minus imports. So when you take that into aggregate, that is what GDP is. And when mortgage rates go up, means spending goes down, cost of borrowing is going up. That means that basically consumption is going down. And actually, when you look at this formula, in the UK and the US, consumption, this is taken from the globaleconomy.com website, it's showing you what percentage of GDP consumption is made up of. So in the case of the United Kingdom, it's 60.57%, US it's 68, and you can see over the last 3 months and over the last 12 months, it stays fairly flat around those levels. So consumption is a big component or a major component of GDP. And obviously, if suddenly you increase the Fed fund rate or Bank of England increases their rates, that has a knock-on effect in terms of how, in terms of mortgages and the cost of people's mortgages going up, meaning they have less to spend because they having to pay more in their mortgage payments. So taking to that into whole, there are possibilities of a recession, and that's why people are talking about recession. So the reason the Federal Reserve and the Bank of England went to raise rates is on the fact that they are trying to curtail inflation. What does that sort of mean for investments? Two things: you have the foreign exchange effects, and then you have the equity effects. So foreign exchange being sort of currencies and currency exchange rate. So what this chart is showing is the rate in which the pound and sterling has been over the last year. So it's gone from all the way to sort of 1.35 all the way down to 1.1, which means that the cost you get per dollar is less than you would have got in the past. So before you'd get 1.35, now you're getting closer to 1.1 for every pound that you get $1.1. So the dollar is strengthening and the pound is weakening. And that has effects in terms of import and exports. Exports are going up. Sorry, cost of imports is going up because especially if you're importing from the US, then that cost goes up. But on the reverse, if it's a US company, suddenly all their revenue that they're earning overseas is going down. So when you start thinking about that, these big multinational companies which have overseas subsidiaries suddenly have less revenue. But you could say maybe the costs go down. So it's looking at the net effect of the costs versus the revenue they get from those countries. But most of the time, it's a US company, they probably have cost-based structures in the US, and they're susceptible to the revenue that's coming from different countries. Now, if the US is dollar stronger, they're getting less dollars just by pure FX change movements. So what does that mean? What's sort of happened in the markets because of that interest rate environment? Well, you've seen both in the UK, it's down 5%, and in the US, the S&P 500, which I'm looking at, 21%. UK 50 100 here and S&P 500 here. But why is the stock market down, you may ask? It's all to do with kind of how stocks are valued. So I'm not going to talk about it in this video, but ultimately the stocks are valued on a DCF basis. So what that means is it's the present value. So you take future cash flows that the that a company is giving you, and you discount that back. That discount rate, the interest rate, plays a factor in that. And the higher the interest rate, as you can see in the formula, the lower the DCF or discount of cash flow that you're going to get, meaning the stock price should be down. That's one element, but sometimes the stock market can withhold, high interest rates, so the market shouldn't crash. This actually can also be driven by the recession fears. So if there's a recession, like a drive down in consumption, then all these higher growth, more consumer discretionary companies will struggle much more in a recessionary environment, or fears of that, because at the end of the day, stock markets are all pricing in expectations. So if expectations change, then it has ramifications in the stock price, and then also the high debt level. So because debt, as we explained before, the cost of borrowing is going up, what that means is that it'll be more expensive for companies to borrow. So companies which aren't profitable might be borrowing more, and that can have ramifications on sort of companies being able to easily borrow cheap money, so they can't invest as much, so they're likely to maybe not make as much revenue, spending goes down. So that's sort of the negatives. But if we take a step back, and as I promised at the beginning of the video, how can we take advantage of this? So the previous chart I showed you was the stock market year to date, but this is a very, very, very long period of time. You see that the stock market goes up. So actually, these lines representing where you had bear markets, you suddenly have these bull markets over time. So you always have bear markets where things prices go down, but you also have a recovery in bull markets where over a long period of time, stock market goes up. And that's kind of what we're talking about here in the Money Cog, which is focusing on long-term investments and looking at companies which can rise over a long period of time. You're not always going to get it right. And that's why we've produced our premium research on the moneycog.com website, which you can check in the link below, which talks more about those opportunities in terms of where you can get long-term investments into good stocks. And when we analyze the fundamentals, how the company makes money, financial statement analysis, valuation, competitive advantage is all there in all the companies that we look at. So go and check it out in the link below. But this is again just showing you in the long term, it doesn't really matter what interest rates are, inflation is. It kind of balances out in the long term. So if you've got a long-term mindset, which we should always have, so we focus on the Money Cog, then these things are great opportunities because you've seen suddenly prices down 20%, 60%. Some of them could be overvalued. Sorry, not overvalued, but some of them could be undervalued or been taking a massive hit. Great opportunities. So once again, hope you like this video. If you want to see more, subscribe, give us a comment.